Welcome to the Possible Promise Podcast. Every Monday, Wednesday, and Friday, and sometimes Thursday apparently, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial success. Today is July 2nd, 2020, and I am your host, Brandon Oliveris.
And I am his amazing wife, Christine.
This is episode 10, How to Select the Short Strike. Welcome everyone to the podcast. So today is not usually a day that we do this, but as we found out on air yesterday.
Sorry, it was my fault.
Well, no, it was good because I was thinking like otherwise I would have woken up this morning and thought, hey, wait a second, we can't do a podcast tomorrow, and that would have been very bad. And so yeah, I mean it was kind of last minute, but not as last minute as it could have been.
Yeah. You're welcome.
So
it's what I'm good for.
It's good that because tomorrow the market's closed. Boo. And so today's the last day of the week, so we figured we'd do our week in review today and do our topic, and so that's fun. So
we should update everyone on the bed that came yesterday.
Oh yeah, that's a good point. So we were talking about the bed yesterday, and not that it's on topic at all.
It's not
at all, but. It was amazing.
Yes.
It's such it's Dream Cloud, just to plug them a little bit.
Yeah.
It was very nice. It was worth the 4-week wait.
Oh.
It took forever because all the backups of the coronavirus and stuff. But yeah, it was pretty sure we're in heaven. It was really nice.
Yeah.
So yeah, beds are one of those really important. You don't know how important they are until you don't have a good one and you can't sleep because, you think, when you go to sleep at night, that's like your respite, that's your pause for the day, But if you can't sleep well, then it influences every other part of your life, I think, so.
Yeah, I agree. Well, of course. Except you don't sleep much.
I don't sleep much as a rule, but on the old bed, I really, really, really didn't sleep much.
No.
I could sleep maybe 2.5 hours, and then I was awake and I was hurting and it was bad. So this one's a lot better.
Yes.
Anyway.
That was apropos of nothing.
Apropos of nothing. So yeah, today is... the market just kind of decides that it wants to keep going up. Well, to be fair, okay, so we had some good numbers today. Unemployment was 11.1% versus, I think, 12.5% estimated.
That's good then. It's going down.
Yeah. And then jobs were, I think, 4.5 million versus 3 million that were expected, or 2.9 million or something. So that's all good news.
Wow.
Now I want to read this tweet because I that is good news, very good news, but, let me find it.
Are you going to be grumpy?
A little bit.
Aww.
No, so I found this tweet that, I think makes a good point. I'm going to read it to you. It's from this, I don't remember what her name was now, but she's from the Washington Post, Heather Long, that's what her name was. But she said, the U.S. gained back 4.8, I misquoted that, 4.8 million jobs in June. But there's a big asterisk. Take a look at the chart below, which I'm sorry, I'm visually impaired, so I can't really tell you what it said. The Labor Department's job survey was done in mid-June, just before the big surge in COVID-19 cases. And it gives a link to that. So it may not be the most accurate number ever, because it was done right before, in the middle of June, we had that big surge in cases as everything was opening up.
Way to put a damper on good news.
I'm very sorry. I'm just, I saw it and I thought it was important.
No,
And
I
also, I think a significant number, I want to say 40% or something huge like that, of the new jobs were from the leisure industry, like, hotels and places like that are coming back into business. So I think this month, I doubt we'll see that as much. So I don't know. I'm just curious what next month's numbers are going to show us.
Or this month.
Well, but yeah, this month's numbers, but it's not reported until August.
Oh.
Yeah, so this month they reported June's numbers. Next month they'll report July's numbers.
Yeah, that would make sense.
So I'm just curious what it's going to show next month. We'll just have to see. But that's just some caveats to that. I mean, it's really good news, but it's kind of like how in April they reported March's numbers and it looked really good, but it was only from mid-March before the whole shutdown happened. So it didn't really look as bad as it was. But I kind of think that in August it'll show maybe a bit not as great of a picture as we think. But the market doesn't care. The market's up. I think it's off of the highs, but it is... Let me see how we're doing today. So the S&P is up about 28 points, about almost 1%, 92 basis points. The Dow is reaching for that 26,000. It's 25,966. So up over 200 points, about 0.9%. The NASDAQ is obviously, as always, outperforming everything else, up over 100 points, over 1%. And the VIX is even lower than yesterday, down 5%. Over 5%. 5.18%.
Oh, I've missed the 5 part.
Yes. It's not down 18%. That'd be quite something. I'm so mad at myself. Okay, so I said on Monday how, I thought volatility was going to contract this week, and I had this whole conversation with someone where they thought it was going to increase. I thought it was going to decrease. I thought, I wonder if I should, buy a put on the VIX and maybe profit from my guess. And I didn't do it, and I could have saved, because it went down a good 5 or 6 points this week. Let me see what was that on Monday. Hang on. It went down quite a bit. Let's see. Yeah, on June 29th, it closed at 31.78, but let's see, last Friday, it was... Oh, wait, no, it's 26th. That's Friday. It was at over 34. So now it's under 28. So, that kind of... I should have bought a put.
Well, that's not my fault.
Yeah, I get these feelings about, I think it'll go down, and then I don't do anything about it, and I could have profited off of that.
If you don't start acting, that gift might just be taken away from you.
Oh, thanks.
I'm just kidding.
You're very nice. No, it's just logic. It's not a gift.
I know.
It's just,
No, because you always talk about your intuition.
Yeah, I don't know.
That's what I meant.
I know. It's just a feeling. I thought, it might, it's probably going to go down.
You should actually learn to listen to those.
I should probably.
You could have made a lot of money.
Probably.
See?
You're not helping.
I know.
So.
I told you it's my job to pick on you on this podcast.
I know.
But it's okay. No, I understand, though, because sometimes you don't think, your intuition is different than what it shows, so it's like...
Right, yeah.
I really do understand.
Yeah, I mean, it just depends. Sometimes you're way wrong, and then you suffer, and then it just, it just depends. I'm going to quote what Tom Sosnoff from Tasty Trade said this morning, and I agreed. He said, Monday I thought it was overbought, Tuesday I really thought it was overbought, Wednesday I really thought it was overbought, and then there's today, where it's still up even higher. The market, the S&P, the market in general, it's just, it keeps going higher and higher, Tom
needs a wife or something.
I don't know if he has one.
Oh, God.
Sorry, I showed Christine Tasty Trade this morning and how grumpy Tom can be. And she's
just... Oh, I don't like old geezers.
Okay. And moving on. Let's get to our week in review, all right? Let's move on from that. It's not that old.
I know, but he acts it, okay?
I do too sometimes. So.
Not that bad.
Right,
trust me.
All right. Let's get to our week in review. So the week in review, as I said, the market is way up this week. VIX, the volatility's down. So what did I say? It just was 27.14. So I mean, from that to last week, let me just see. It's like, I mean, it's down like, is that like 20% from last week? Am I reading?
What was
that
it?
right?
I didn't. It said it too fast.
27 down from like 34. So yeah, it's down like,
Wow.
that's 7 points. So yeah, it's down like 20% from last week. So that's
Yeah.
huge. It kind of adds up, and the market itself is up. Who knows how many percent? This
You think
week.
it'll keep going up, or do you think it's gonna has to drop sometime?
I think that traditionally the 4th is any kind of holiday weekend is usually bullish, and so there's that. There's the vaccine news from yesterday with Pfizer. There's the good jobs reports, job numbers. I think gravity will start pulling down on the market soon.
Yeah, it'll have to.
It'll have to. So it's just yeah. I mean, it's going to have to eventually.
Yeah.
It's been going up. I don't know how many days up it's been at this point. It's at least all this week. I don't remember if Friday was up or down, but gravity will take hold eventually and it'll come back down. Remember what we talked about with the pendulum effect,
Yeah.
And that reminds me of something I want to talk about. I'm not going to talk about it now because it's part of our topic, but about, what to do when it looks like the market's going against you. Remind me of that, please.
You mean later today?
Yeah.
Okay, I'll try.
Cool. So, the market's been going up this week. I think it's, let me see how far the market's up this week. I'm curious. So right now we have the SPX, which is the S&P. We're going to call it 3145. And last Friday it closed, 26th, 3009.
Oh, wow.
So obviously way up. That's about 4.5% in 1 week. So that's a massive move, obviously.
Oh, yeah.
I think any logical person would say it's gonna
have to come down.
Have a down day here soon. So yeah, that's what's going on with the market this week. Myself, things are going pretty well. I haven't checked my portfolio since earlier this morning. It was pretty down at first because
you lost a little bit yesterday, right?
I lost just a little bit, about 1% yesterday, a little less than 1%, I think. Today I was down a couple percent in the morning, and then it kind of rebounded a bit. I was still down a little bit, maybe another percent, but I'm up for the week, roughly 2%.
Yeah, you are. That's
so
awesome.
So my wins for this week I haven't written down because I didn't want to forget. So I had a successful trade on XRT, just closed out this morning. That's the retail ETF.
Okay.
XLF was just yesterday. Was it yesterday or the day before? I don't remember. I think yesterday. That's the financials. So I had that really nice. It was a nice little, not guess, but kind of happenstance.
That was Tuesday, I think, when that happened.
Well, last week I opened up XLF.
Okay.
I had a short position. I had a call credit spread on it. And that was the day when they had the stress test. Remember that last week?
Very vaguely.
Yeah, because you were joking about the stress test, The banks had the stress test.
Oh, yeah, that's right.
Yeah,
okay.
So then I almost... so I take at 50% profit is where I close my trades. So I got within a couple of pennies of my profit target by Monday, and then it was just kind of hanging around there until like yesterday or maybe Tuesday, I don't remember, and finally closed out. So I got XLF, worked out well for me. Now the funny thing is, so then not the next one, but KRE, which is it's a bank. It's I think the regional bank ETF. I had also a bearish call on that, and that one worked out great for me because that one actually was supposed to expire today.
Uh-huh.
And Tuesday it was breaching my short strike, which just means it was going like way against me. It was not going where I wanted it to go. Yesterday it fell along with all the financials, and I was able to close that one out. That one worked out really well. And then it's just funny because I had a bearish trade on that, but I have a bullish trade, a put credit spread on USB, US Bancorp, I think was the name of the stock.
Oh, cool.
That one was going down along with all the financials the last several days. Today it's going up. So today I had to roll that one out I rolled it out to next week just because I think I just needed a little bit of extra time.
Right.
Because I didn't know where it'd be today because it was kind of way under where I wanted it to be. Today it's way up, so that's good news. XLU is utilities ETF, and that one closed out at a profit. And then MU, Micron. That one, they had earnings Tuesday. I think I told you about that one, Christine. I don't remember.
I don't know if you did.
What
is it?
MU. They're called Micron.
I don't remember.
They had earnings Tuesday morning, I think. And
sorry if I forgot.
No, I don't. I have lots of trades. I don't expect you to remember. I had a bullish position on them. They were kind of sinking for a while last week, so I was kind of nervous. But Tuesday they hit it out of the park.
That's awesome.
Stock went way up. I got an email literally 1 minute after market open that my trade had closed, so that worked out well.
That's awesome.
So yeah, those are kind of, and then let's see. I have Tilray, I think it's pronounced TLRY.
Oh, that's the one you told me about.
Yeah, that's that one's suffering, and I don't know why. I haven't found any news. I haven't found anything. It's just day by day. It's just been suffering.
That's weird. There's not even any news about.
Yeah,
anything.
that one I rolled out to August to kind of give it a little more time, and then CF, which I don't remember the name of. CF is CF Industry Holdings. It is what it is what it's called. The ticker says. That one I rolled out to August because that one has been kind of going against me. So overall, it's been a successful week. And I closed out, what was that, like 5 or so successful trades. So
that's really awesome.
It's been really good. So yeah, it's been a profitable week overall. Today is kind of down a bit. We'll see where we are by the end of the day. I mean, who knows? It's just, the day's just starting, right? Yesterday was a little bit down, but overall,
you just never know what the day will do.
Yeah, overall, we're up for the week. Well, I'm up for the week. You don't really trade.
That's true. But we're one.
Sure, yeah. So I'm up for the week. That's good. So
and
yeah,
plus
those.
You share your money with me, so it's okay.
That is true. So those are my trades for the week and kind of what's been going on in the market. I don't know what's going to happen next week. We'll just have to see. I would think. I'm hoping for some sort of pullback, but we'll just have to see what happens. I mean, who knows, right? So that is our week in review, and we will now get into our main topic. How to select the short strike. Now, I have some notes on, I actually wrote down a few notes on how I wanted to talk about this. I know. So,
when do you want me to remind you?
In a few minutes.
Okay.
But that was, asking that is a reminder in itself.
That's very true.
All right, so yesterday we talked about, basically how much to risk at a time. Now, mainly when we're talking about options, we're talking about credit spreads or any kind of credit strategy where when you open the trade, you receive money instead of paying money for that trade, right? So it's a totally different thing from debit strategies, obviously. So that's what we do most of the time. And so yesterday we were talking about, how wide should your spread be? And if you remember, I said that you want to risk about 2 to 3%, not 50% like you said during the thing. You remember that? You said 50% when I asked you? During the Ask Christine
Oh,
thing,
yeah.
Like, no, not 50%.
Because I was confused with
I
the
know,
question.
it was a lot of stuff. But yeah, 2 to 3% is what you want to risk. And so, that kind of dictates how wide your spread can be, right? So just to summarize, if you have a $3 spread, now remember this is for 100 shares, so a $3 spread is actually worth $300, right? Because it's, 100 shares.
Yeah.
Right? $3 times 100.
Yeah,
is
300. Yeah.
So, but if you receive, let's say, $1 credit for that, or $100, then you're not risking $300. You're risking $200 because, you can only lose whatever the spread width is minus your credit.
Right.
So if I have a $300 spread or $3 wide spread and I get $1 credit, I can only lose $2.
Yeah, that
right.
makes
So
sense.
$3 spread minus $1 credit, $2.
Or 200.
Right, 200 exactly. So you're keeping up.
Yep.
So when you're counting your risk, don't count the spread width because that won't give you an accurate depiction.
That's
Count
true.
the spread width minus your credit. I didn't really emphasize that enough yesterday, I feel like, so I want to do that now. So your spread width, minus the credit should be what you're willing to risk. Right?
That
So
makes sense.
yeah. So 2 to 3% of your portfolio. So yesterday we talked about how wide your spread should be. That basically is what dictates that. I mean, that's not the only thing that goes into it. There are other things. You might prefer smaller spreads. You might prefer larger spreads. But the maximum should be whatever you're willing to risk, that 2 or 3%.
Yeah.
Today, we're talking about where to position your spread. And so...
That sounds complicated.
It's really not that bad.
Okay.
So this just dictates... So a spread, if you recall, a credit spread, or any spread generally, or most spreads, have one long option and one short option. Now that just means a long option is an option where you are buying it, you're paying money to open that option, and a short option is just where you're selling it.
Okay.
Right, just like with long stock is where you're buying stock, you think it's going to go up. Short stock is where you're selling stock because you think it's going to go down.
Okay.
Options are the same thing. A long option just means you're buying an option with the hope the option will go up. A short option just means you're selling an option with the hope the option will go down. Right?
Okay, that makes sense.
Yeah, so a spread has usually one long and one short. Simple spreads. We have more complex spreads like iron condors, iron butterflies, and things like that, and even ratio spreads and calendar spreads. So we'll cover that one day.
God.
But the basic spreads, the debit spreads and credit spreads, have one long and one short option.
Okay.
So especially with a credit spread, you have one short option that's closer to your stock's price and one long option that's farther away to kind of limit your risk, your maximum loss, right? So if you have your spread width, which is what we talked about yesterday, the only other question is, where do I place the short strike? The option that I sell. That's kind of the most important one. The long option is kind of an afterthought after you figure that out.
Why do you need one of each?
So if you just have a short option, if you remember we talked about this, I don't remember when, a couple weeks ago or last Friday maybe, option spreads.
Yeah, I think it was last week.
So if you just have a short strike, a short option, your risk is undefined. You have unlimited risk, basically.
Oh, okay.
So, if I have on a $100 stock and I sell a 95 put, I have undefined risk because the stock could go anywhere from $100 to $0, and I'm at risk. Whereas if I buy an option that's lower down, so let's say 95 short to 90 long, then I can only lose that $5 width.
Oh, I see.
Right? So it just defines my risk. It just limits, like instead of being able to lose everything, I can only lose the width of that spread minus the credit.
That makes sense.
Yeah, so that's why. So, I mean, people do like naked options, just selling the short. And there's, we have we talked about this a little bit, short strangles, short straddles, which are basically a combination of call and put that are both short without any defined risk. It's just unlimited risk, but it also has a better payout. That's not what we're going to talk about today. It's not something I do too often. I know a lot of people do it all the time. Not something I do right now. And it's not something you want to do with a small portfolio. So if you're starting small, you want to do defined risk. You want to make sure your short option, the option you're selling, has a long option to offset it.
Gotcha.
Okay, so that's why. So
I was just curious.
Yeah.
That was interesting.
So, and the difference between those two options defines how much risk you're taking on. So, like I said, if the short and long option are $3 apart, and you receive $1 credit for it, you can only lose $200. Right? Remember we talked about that just a few minutes ago.
Yes.
Right. So that's it's just defined risk. So
That makes sense.
Only question then, once you decide, okay, so this is how wide I want my spread, this is how much I'm willing to risk, the only question left is, where do I want to put my short strike? Now, that question will basically dictate how much profit you can receive. Right? Now, basically, let's say you have $100 stock and you want to open up a credit spread, either a call or a put, doesn't matter. So, the closer to your stock's current price you place that short strike, the more credit you'll receive. Because the closer it is, the less likely you are to win. Right?
Oh, yeah.
And the more risk you're taking on.
Right.
And so, the closer it is, it's a risk versus reward sort of thing. The closer your strike price is to the current stock price, the more credit you'll receive.
Oh, that's really cool.
Right, because basically, like, if I have a $100 stock and I sell a 99 put against it, remember, selling a put means you think it won't go under that price.
Right.
I only have $1 wiggle room, which is not a lot, right? I mean, I could do that in one day. Versus if I sell a 90 put, that's a lot more, but I'm going to get a lot less for it because it's a lower risk, or higher probability of profit, as we say. You're more likely to win, and so the more likely to win you are, the less money you'll receive for it.
That's not how it should work. Just saying.
I know. Well, it has to be that way, because otherwise, why would people trade it? And so it's just probabilities. So it's just, with credit strategies, you have the ability, well, with any options, you have the ability to kind of dictate how likely you want to be to win. And so it's a balance, and so you might think, I want that strike price to be as close as possible to my stock because I'll get more money for it, but again, you'll lose more often. Mm-hmm. Or you could think, I want it to be as far away as possible so that I have a huge likelihood of winning, but then you only get a very, very, very small credit for it, and even though you're extremely likely to win, there are times you'll lose, and when you lose, you'll lose big. Right?
Yeah.
So if I have, let's go back to that $3 credit spread. And I was giving a $1 example, but if I go way, 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 way out of the money, let's say I only get 20 cents instead of $1.
Whoa.
Right? Now I'm risking $2.80 because, $3 minus 20 cents credit. Now I'm risking a lot more. I will only get a lot less. I'll only get 20 cents. So while I'm more likely to get that, it's when I lose, it'll wipe out a lot of my winnings.
Right.
Right. So it's just a balance.
Yeah.
And so you want to find the right balance for you where, you're letting the probabilities play out, but you're getting enough money for your trades that it's going to be worth it in the long run.
Well, you want to make just enough, risk.
Right.
Yeah.
All right, so the short strike needs to be out of the money. Now, out of the money, actually, we're going to ask Christine. Do you remember what that term means? Okay, let's do it this way. If I have $100 stock and I'm selling a put option at $95, would that be in the money or would that be out of the money?
That would be in the money. No?
No. So basically, and by the way, just so there's not a misconception,
I asked for
she
these.
asks me to do these little things.
Even
these
though,
questions.
yes, I know it makes a fool out of me, but one day I'm going to get one right.
That's right. So,
They're fun to do.
and then this helps me know what needs to be clarified anyway. So,
Yeah, it does. I don't mind doing that.
in the money,
Darn it, I got it wrong.
I'm sorry. In the money means that if you were to exercise that option today, if you were to sell that option today, that you would get money for it. So that it's worth something intrinsically.
Oh, okay.
So, for example, if you have, a 95 strike call where the stock is worth 100, it's in the money because it's worth that $5, right? Because a call says it's going to go up. Whereas if I have a $105 call, it's not worth anything because if the stock price is 100,
You can't.
the call isn't worth that. I mean, yeah, it's not worth anything. Because a call is saying I can buy 100 shares of that stock at that price, but I wouldn't buy it at 105 when it's currently 100.
Right, why
Right.
would you?
Whereas a put in the money would be, let's say, 105 versus 100 because it's lower. The price is lower than the strike. Because a put is saying I can sell these shares at that price. Well, why, I would want to sell it at 105 if it's currently at 100. I'd make a $5 profit.
Oh, okay.
But if the put's at 95 and the stock is at 100,
Then it's
I'm
out
not
of
going to
the
sell it at 95. I'm going to sell it at 100. So it's
Right.
not worth anything to me
Oops.
today. Right. So it's good.
No, that's confusing.
It does get a little
You
confusing.
have to, do gymnastics in your head.
You have to do gymnastics in your head. That's a good one.
You do.
I know.
Mental gymnastics. It's a thing.
Yeah.
It's a term.
I'm joking. I know. It's just funny.
Uh-huh.
Just the picture in my head is funny. So,
We all know that you have visual pictures.
I know. I'm a very visual person, even though I'm blind. It's funny.
Yep.
So, if, you have a credit spread you're opening, your short strike needs to be out of the money. Now, that's not a hard, requirement. You can go and open up a spread where the short strike is in the money. But why would you? Because that means that you're actually less likely for that to be... You're starting out at a loss, because if the short strike is in the money... Now remember that with a credit spread, you want it to expire worthless.
Oh, that's right.
Because a credit spread, you receive the credit up front, where if it expires worthless, you get to keep it.
Oh, yeah.
The buyer wants it to be worth something, you do not. The seller does not want it to be worth anything. So if I'm starting in the money, that means it's already worth something.
Right.
I'm working against myself, right? So why would you want it to be, in the money? Your probability of being out of the money is going to be less than 50%, right? So you want it to be, and now, there are some cases where I'm sure you could think of where you might want to do that, but honestly, if you're going to do that, I would rather do a debit spread where one strike is in the money and one strike is out of the money versus a credit spread. It's better to have both strikes out of the money, right?
Right.
Because you're starting out with a high likelihood of winning, right? So you don't want to start, you don't want to have your short strike in the money because you don't want it to be worth something, right? Yeah, because again, if your short strike's in the money, if it's worth something, as a seller, that's working against you. You don't
Right.
want it to be worth anything.
Okay, so you want the short strike out of the money.
Right.
Yeah, okay.
So, that's just one thing. So the question is, how far out of the money do you want it to be? And I already described what in the money versus out of the money is. All right, so how far out of the money, that's the question, right? So it definitely needs to be. So if you have a put credit, your short strike has to be underneath the current stock's price, because that's out of the money for a put. Mm-hmm. If it's a call credit, then your short strike needs to be above the current price because that's out of the money for a call,
Yeah, okay.
right? Now the question is how far. Now there are a lot of things here that go into it. You obviously, again, you can target how likely it is to win. And so if I tell you we're going to set up a game where every time you win, you get $50, and every time you lose $100. But you can decide how likely you are to win. You can't say 100%. But would you say you want 50% likelihood to win? No. Because if you're equally likely to win 50 as to lose 100, you're going to lose overall, right?
Right.
If you say win 5 times and you lose 5 times, well, you're only winning 250 and losing 500, so it's not really worth it. Mm-hmm. Do you see what I mean? So you want more than 50% likelihood.
Yeah.
Right? You want it to be in your favor. So what we do is we look at, there's some statistics on the strike prices for options that you want to look at. So it depends on what broker you use. A lot of them have something called probability OTM, probability of being out of the money, or they might have chance of profit. I've seen it in Robinhood. Whatever. Probability of profit is a slightly different thing, but it's related. Or you might just see probability ITM, which is in the money. Okay? If you have a chance of profit or probability OTM or anything like that, you want it to be definitely way over 50%, right? Because you want to win most of the time, right? So if it's over 50%, obviously you're going to win most of the time, more than you lose, which is what you want, right?
Yeah.
So you want to have a probability OTM, which is probability of being out of the money at expiration, of at least 70% is the general rule, right? You could go more than that, but generally you want over 70%. Or at or above 70%. So that means if your probability of being OTM is 70%, that means that by expiration, your credit spread is 70% likely to be worthless. Right?
That's crazy.
Which means if you do, 100 credit spreads, you're going to win 70 of them and lose 30 of them.
Right.
Right?
Which is really good.
Right. So that's generally what you want. Now, because that is kind of the level at which your risk to reward ratio is worth it, right? If you go much higher than that, you're going to start not receiving that much of a credit for your spread, which is not what you want. So at about 70%, that's kind of the sweet spot for, how much money I'm receiving for the spread versus how likely I am to win, right? And so about 70%. Now, if you don't have that, most brokerages do, but if you don't have that statistic, the probability OTM or chance of profit, then you will have delta. Now, I'll explain that in a second. What I want to mention first, real quick, if you only have probability ITM, which is the probability of being in the money, logically, that's just the inverse of probability OTM. So if your probability of being out of the money is 70%, then your probability of being in the money
is 30.
Yes,
Woohoo!
exactly. Okay, I'll give it to you. All right, so
I mean, it's simple math, to be fair.
Yes, I know, but I didn't know if I left you behind somewhere. So, if you only have probability in the money ITM, then you want 30% or less because you want to not be likely to be in the money at expiration. Now, if you don't have that statistic, you can make do with something called delta. Now, we will have an episode one day very soon, maybe next week, maybe the week after, I don't know yet, about what's called the option Greeks. There are 5 basic... Huh?
Before we do that, do you have to talk about if the market goes against you?
I'm going to, yeah.
Okay.
That's going to get there after we talk about all the math of it.
Okay.
So, we're going to talk about the option Greeks. The Greeks, there are 5 basic Greeks, which are just basically Greek. Actually, not all of them are Greek letters. So I don't know why they're called that.
Yeah, I was gonna say. I'm curious what they're all called.
Well, the 5 basic ones are delta, gamma, theta, vega, which is not a Greek letter, I don't think, and rho. Those are the 5
Rho
basic
is?
ones. Yeah, rho is, yes. Vega is not.
Are you sure?
I'm almost positive.
Huh.
Yeah. Anyway, those are the 5 Greeks. There are others. I've heard of phi. I've heard of alpha. Or yeah, there's just some other ones that I don't mess with, and I'm not going to talk about. But the 5 basic ones you'll see in every brokerage are delta, gamma, theta, vega, rho, and so we'll talk about them one of these episodes. They are very important. But the most important one for our purposes today is delta. Delta, it's always a number between -1 and 1. It's some decimal. Mm-hmm. If it's a call option, it's from between 0 and 1. If it's a put option, it's between 0 and -1.
Oh, okay.
Okay. And basically what it tells you is for every dollar move of the stock, how far will the options price move? So literally, let's say a 0.5 delta. In when we're talking out loud about it, we'd often call it a 50 delta.
Okay.
If it's a 0.5. For a 0.5 delta, if the stock moves up $1, the options price moves up 50 cents. Okay? So
Where
that's
did you get that?
a point. That's just 0.5,
Oh, okay.
50 cents
okay.
of a dollar. You know, is,
Right.
yeah. So whatever that delta is, for every dollar the stock moves up, that's how much the options price moves up with it,
Wow.
and vice versa for down. And the delta is always moving. It's not a constant. It's not static. It's always moving second by second by second when the market's open. But let's take it, like I said, a 0.5 delta, we call it a 50 delta. If the price of the stock moves $1, the option price moves 50 cents. If it's a 70 delta, if the price moves $1, the option price moves 70 cents.
Right.
Get it? And so with any option, with a call option, the closer to being in the money that it is, and the closer to expiration, the more the delta approaches 1, because eventually the options price will move right along with the stock's price. With every dollar the stock moves up, the options price will move up to $1. Mm-hmm. With a put, it's the opposite. The more a put is in the money,
it'll go down.
It'll go down to -1. Right, exactly. So a delta, that's just a basic overview of what delta is.
Yeah.
But delta kind of gives you a shortcut of how likely it is to be in the money. So a 50 delta or 0.5 delta is about 50% probability of being in the money at expiration. Right? It's not exact, it's not precisely the same thing, but it's a useful shortcut.
That's so cool.
Right? So whatever the delta is, turn that into a percentage, and that's the probability ITM approximated.
Okay.
Right? So a 50 delta is about 50% ITM, probability ITM. 30 delta is about 30% probability ITM. Again, not exact, right? But, so if you don't have the probability OTM or probability ITM or things like that, then you want to look at delta. And so your short strike, you want it to have a 30 delta or less, or 0.3 or lower for calls, or a negative 0.3 or higher. So just take the absolute value of it.
Yeah.
Right. Whether it's a call or a put. 30 delta or lower, which tells you it has a 30% probability of being in the money or lower for the option.
Right.
So it's just a shortcut. Right? Mm-hmm. So your short strike, you want to have about a 30 delta or lower.
That's crazy.
Yeah, it's a useful shortcut. It's really useful. I used to use it all the time because that's all my broker had. I didn't have the probability OTM and all that.
Oh, so you don't use it as much anymore?
I look at it, but I don't use it as much as the probability.
Okay.
But it's a useful shortcut. It worked well for me.
It's what I would use because I'm so lazy.
Well, usually it's both. They're both right there, right? So it's not a matter of being lazy. Both the numbers are right there for you to look at. It's just some brokers don't have it.
Oh, okay.
It just depends what you use. So yeah, you want your short strike to be, just as a summary, about 70% probability out of the money, OTM, or 30% ITM. They're the same thing. Or if you don't have that, then about a 30 delta or less. Right?
Okay, yeah.
So that's the rule we go by, because at about that price, you're going to get a decent premium, a decent credit for your spread, and your likelihood of winning is over 70%. So that's pretty good, right? So that's kind of, now that is just for credit spreads. For iron condors, we do a little bit differently, where we look at a 16% in the money or 84. Yeah. 84%.
I don't know what you did.
I was subtracting 16 from 100 and failing.
Okay.
84% out of the money for iron condors, because there are two sides to it. We won't talk about today.
Oh, yeah, that's right.
Yeah, so for basic credit spreads where you have one short, one long, you want about a 30% in the money or 70% out of the money. Right, and just through research, that's the best risk to reward ratio. Usually, okay, so if you have a $1 wide spread, usually a 70% probability of OTM will get you about a third of that in credit, so about $30, $33 per dollar of spread, right? So you want, the credit you want to get is about 1/3 of the width of the strikes. So again, that's why I said a $3 spread, you want to get about $1. A $1 spread, you want to get about 30 cents.
Can you start that all over again?
So
you're
the credit you want to get for a spread is about 1/3 of its width.
Width?
Of the width of the strikes, the distance the strikes are from each other.
So you want to get,
So a $1 wide spread, you want about 33 cents.
Okay, yeah. Okay,
Right,
I'm sorry. I'm really bad at math.
That's okay. Or about 30 cents is usually what I go for.
Yeah.
That's generally, if you're about a 70% probability OTM, that's usually about what you'll get for a good stock.
Right.
Right? A good volatile, high volatility stock. And so that's where your short strike is going to be. That's what you're going to choose. So it's not a matter of anything else besides just pure numbers, pure probability. Where do I want my probability to be? How likely do I want to be of winning this trade? And I want to be about 70% likely.
Okay.
And 70% likely, if you manage it well, will actually, as I've been saying, turn into 80 or 90% likely to win. Just if you manage it well, if you take 50% profit, all that kind of stuff, if you adjust when you need to, and all that. But 70% is your base. That's no less than that will you win.
That's crazy.
Yeah, so that's what you want. And so, now I'll talk about what I asked you to remind me of, which is just this. So the probability of being out of the money is not the same thing as the probability of the stock touching that strike. What they call the probability of touch.
I love it.
So, what that means basically is sometimes you'll sell a credit spread, and then in the next few days or the next week, the stock will go against you. It'll actually touch your short strike, and you'll think, oh my gosh, I'm going to lose this one. And maybe you'll sell in panic. Don't sell in panic just because the stock hit your short strike.
How come?
Because the probability of touch is actually about double the probability of being OTM. Oh. So if you have a 30% probability OTM, you have about a 60% probability it's going to touch your short strike at some point. Huh. So that means over half the time, it's probably going to touch your short strike. So if you panic and sell anytime it hits your short strike, you're going to sell over half the time and lose.
Wow.
So you have to let the probabilities play out, right? You have to let it happen. You can maybe roll to the next month if you want to, or whatever.
That's what you do.
Yeah, I roll it, right? And we'll talk about rolling. We'll talk about adjustments in a future podcast. But you don't want to sell it just because it touches your short strike, because then you'll be selling over half the time, and that's just not going to work, right?
Yeah.
You're going to lose most of the time instead of winning most of the time. So when people do this, oftentimes they'll say, oh, I'm actually losing more than I'm winning, and it's because they're selling. They're panic selling.
So they're being impatient.
Mm-hmm. If you have a defined risk trade, you almost never want to close it out early unless both strikes are in the money and it's just so far in the money that it's just really not likely to win, or something like that. But you almost never want to close it out at a loss without at least trying to roll it out or something like that. There are exceptions, but it's just if you sell it just because it's reached your short strike, you're going to lose most of the time, right? Because again, the probability of it touching the short strike is about twice of just the probability of being out of the money. So a lot of times the stock might go in that direction, but then it'll turn around at some point. Remember this and we'll talk about days to expiration another day. But let's say you have an option that is going to expire in a month, right?
Right.
In 1 month, listen, a stock can do a lot in 1 month.
Yeah.
Right, just because, and this is what I mean, I have, I'm down today because I have some short positions and they're being touched today. They're, it's going against me today. That's 1 day or even 1 week.
Right.
Right? A lot of these trades won't expire till August.
Right.
So if you panic, you're not giving it the full time. In 1 month, a lot can happen.
Sometimes stuff happens to you, though, and you will close early on something.
Yeah,
I've seen you do it. So
I will close early if it's so far in the money. Like, let's say I have $100 stock right now, and I sell a 95 versus a 90 put spread.
Right.
If the stock falls down to like $80, it's or lower, it's just like so far in the money that it's just not even worth it.
Right.
Sometimes, and often I won't even do that because at that point I really don't have that much more to lose, so it's like I may as well just hold on to it.
Yeah.
But it just depends. There are times where I've been holding this for over a month, it's not done anything, it's just I'm done with it. Like if I've held on to it for over a month and it's just not doing anything,
yeah,
then often I'll close. But that's a discussion for another day. But
right.
I just want to say, don't panic and sell just because it's gone against you. Like I closed nothing at a loss this week, right? I rolled out a couple things, but I closed nothing at a loss. Last week I closed one thing at a loss because I had been holding on to it for over a month. It wasn't doing anything for me, so I closed it.
Yeah.
But this week I closed nothing at a loss. So that's the rule. Don't close at a loss, especially just because it's touching your short strike.
Right.
It's not worth it. You're going to lose most of the time then. Let the probabilities play out. Let it all kind of, play out, see what happens. You have over a month. Like, a lot of stuff can happen in a month.
Right.
Remember, the pendulums, like, stocks go up and down. So you don't want to panic because if it's gone way up or if it's gone way down, it's probably going to turn around at some point.
Right.
And trust me, a really good turnaround, just even for a couple days, will...
It makes a huge difference.
Yeah, will bring you back into a winning position.
Have you ever done that, panic sold, and then it did really well?
Yes.
Yeah.
I have.
I was curious.
I have, yeah, absolutely. I don't do it anymore because that's my rule now. Is I don't sell just because it's losing,
unless you know it really will.
Yeah, unless it's like way, way, way out of the money or in the money rather, and it's just not worth it. But generally, yes, that has happened to me, and I've been like, oh, that happened.
Because I remember.
Yeah,
like,
that's definitely happened. So don't sell just because it's touched your strike. Let the probabilities play out. Let everything happen, and you will get there, or you're more likely to.
Right.
Right? And so that's just the rule with that. So, again, your short strike should go at about a 70% probability OTM, or 30% probability ITM, or 30 delta or less. Right? And so the width of your spread we talked about yesterday. That just depends on how much you're willing to risk. But that's just where you put your short strike. And be willing for the stock to go against you. Just because, I opened up some SPY call credit spreads earlier this week. It's been going up all week. It's not doing great. But I have until August. Right? I'm not going to close out just because that's happening. Because, I think it's going to pull back at some point. It will certainly pull back in the next month, right?
It would have to.
It's just, there are going to be down days. They're not all up days ever. That doesn't happen. Unless you're Tesla. No, just kidding. So just give it time and just see what happens. Just hold on to it. So I'm not an advocate of I'll look at my portfolio balance a couple times a day just to kind of see what's going on. But don't look obsessively at all your positions.
Yeah, you used to.
I used to, and it was so anxiety inducing. Just look, go through all your positions once or twice a day, see if there's anything you need to do, anything that needs to be closed out, things like that. But overall, just let it ride. Just let it play out.
Right.
And that's it. So it's a really simple thing. Follow those rules and you'll win 70% of the time or more. And you will make a profit. It's really not that hard. Right? All that makes sense to you, Christine?
I hope.
Yeah, you got that pretty well, I thought.
Well enough.
Yeah, so, I thought it was pretty good.
I'll forget it, though.
Yeah, maybe then I can ask you next week about it, and then you'll forget, and then it'll be funny.
See, my brain isn't cut out for this.
It's okay.
When I get it, then everyone else has no excuse.
That's right.
Okay?
That's right.
When it sticks...
You're just not a numbers person, which is okay.
No, that's what it is.
But this is just, you don't have to do any math. Just look at the numbers. If it's 70% OTM or higher, do
70%
it.
70% is doing numbers.
But you're just looking at a number, comparing that against the rule, and saying, okay, if it's higher than that, then I'm good.
That's true.
We're looking at the delta. Oh, is it less than 30 delta? Okay, good, I'm good. Right?
Oh, okay, so you can just look at
You're
the
not
number.
doing math, you're just looking at a number
That's
and saying,
true.
okay, is that higher or lower?
Right.
Right?
I can do that.
So it's
that
really
I can
easy.
do.
Yeah. So it's pretty easy. So if you have questions, feel free to ask. You can find the show notes at possiblepromise.com/10. Hey, this is our 10th episode.
Yeah.
I just realized.
You should have had a fireworks
well.
thing. Especially because it's the 4th this weekend.
I did not get fireworks sound effects, so I'm very sorry. We did get real fireworks for this weekend. So
and I'm going to try them for the first time.
I know.
Because I've never...
I used to do it all the time as a kid. It was fun.
I've never been brave enough. We'll see if I set myself on fire.
I really hope not. If I'm here Monday without Christine, then... It's horrible. I'm sorry. All right, so that is our show for today. I hope everyone has a wonderful 4th of July weekend, especially if you're in the U.S.
Are you going to play the outro?
I'm getting there.
Oh.
I wanted to give myself time. I'm getting there.
I'm sorry.
And so, if you're not in the U.S., then just have a regularly good weekend. But
yesterday was Canada Day.
Yeah, Canada Day was yesterday, so we should have said it yesterday. But
I think, did we? Or did you just tell me about it?
I just told you
happy
about it later.
belated Canada Day to those in Canada.
And happy 4th of July for those in the U.S.
And if there's a holiday anywhere else in the world, have fun.
And have fun anyway, no matter where you are.
Right.
For whatever reason.
Exactly.
Right, okay. So, this is ridiculous today. We will see you Monday for the next episode of the Possible Promise podcast. We hope you have a wonderful weekend, no matter what you're doing around the world. And so, thank you for listening, everyone.
Have a great weekend.
Bye.
Bye.